Effective risk management is crucial for the success of algorithmic trading strategies. As trading algorithms operate at high speeds and process vast amounts of data, managing risk becomes even more complex and essential. This chapter explores the key concepts, metrics, and models used in risk management to ensure that trading strategies are both profitable and sustainable. Whether you're a trader or just getting into the world of algorithmic trading, this guide will equip you with key tools to ensure your trading strategy is both profitable and sustainable. Risk metrics and models. Let's start with the key risk metrics that traders use to measure and manage risk. 1. Value at risk, VAR. VAR is a widely used metric to estimate the maximum potential loss of a portfolio over a specified time frame with a given confidence level. For example, a 95% one-day VAR of 1 million means there's a 5% chance your portfolio could lose more than 1 million in a single day. It's critical for gauging extreme losses and is often the foundation for setting risk limits. 2. Conditional value at risk, CVAR. Also known as expected shortfall, CVAR goes beyond VAR by measuring the average loss exceeding the VAR threshold. It offers deeper insights into tail risk, the rare but severe events that can significantly impact your portfolio. 3. Volatility or standard deviation. Volatility measures how much the returns of your portfolio deviate from the mean. High volatility signals greater risk, while low volatility usually suggests a more stable performance. Monitoring this is crucial to understand market risk. 4. Drawdown. Drawdown measures the peak-to-trough decline in your portfolio. It's a vital metric for evaluating the worst-case scenario of losses during unfavorable market conditions. 5. Sharpe ratio. The Sharpe ratio compares your portfolio's excess return above the risk-free rate to the standard deviation of those returns. A higher Sharpe ratio indicates better risk-adjusted performance, helping you assess if the risk you're taking is justified. Risk models and algorithmic trading. After understanding risk metrics, let's look at some risk models that can quantify and help manage these risks. 1. Historical simulation. In this approach, past market data is used to simulate how a trading strategy would have performed under different conditions. It's particularly useful for understanding the historical risk profile of your strategy. 2. Monte Carlo simulation. Monte Carlo simulations involve running thousands of random scenarios to predict a range of potential outcomes and their associated risks. It provides traders with a probability distribution of returns and is excellent for identifying risks under various conditions. 3. Garch models. These models forecast volatility by analyzing historical patterns. By understanding and predicting market volatility, traders can better adjust their risk management strategies. 4. Stress testing. Stress testing simulates extreme market conditions to evaluate how your strategy would perform in those scenarios. This proactive approach helps in identifying vulnerabilities in your trading system before a real-world disaster strikes. Implementing risk controls. Knowing how to measure and model risk is essential, but implementing risk controls is where the magic happens. These controls are the practical tools that protect your portfolio from catastrophic losses and ensure that your strategy remains on track. Let's look at some of the key strategies. 1. Position sizing. This is the practice of determining how much capital to allocate to each trade. Proper position sizing helps avoid large losses by ensuring that no single trade can disproportionately impact your portfolio. By managing position sizes based on the risk of individual assets or strategies, traders can prevent a single bad trade from wiping out gains from other trades. Moreover, different position sizing models like volatility-based or fixed fractional sizing can be used to adjust your exposure dynamically according to market conditions. 2. Stop-loss orders. These automatic orders sell your position when the asset price reaches a certain level, helping to minimize losses during adverse market conditions. Stop-loss orders are essential for algorithmic trading, where market volatility can quickly shift asset prices. They not only help to lock in profits by exiting trades at predefined levels, but also prevent emotional decision-making by automating the process of cutting losses. 3. Diversification. By spreading your investments across multiple assets, sectors, or strategies, you lower the risk that a poor-performing asset will heavily affect your overall portfolio. Diversification can be achieved across asset classes such as stocks, bonds, commodities, or even geographies, mitigating the risk of any one factor dominating the portfolio's performance. 4. Risk limits. Establishing thresholds, such as maximum exposure or acceptable drawdown levels, ensures that your trading activities remain controlled and that losses do not spiral out of control. Traders often set limits on how much they are willing to lose on a single trade, day, or across the entire portfolio. These limits act as a guardrail, forcing traders to step back and reassess their strategies if the market moves against them too rapidly. Evaluating risk management effectiveness. Implementing risk controls isn't enough. You also need to evaluate their effectiveness. 1. Performance review. Regularly compare expected risks with actual results to see if your risk models align with real-world outcomes. If they don't, adjustments need to be made. 2. Model validation. Continuously validate your risk models by comparing their forecasts to actual market performance. Markets change, and so should your models. 3. Feedback and adaptation. Risk management is an evolving process. Regular feedback from your evaluations allows you to adapt and fine-tune your models to stay ahead of emerging risks. Position sizing and portfolio management. Now let's focus on the role of position sizing and portfolio management in risk control. 1. Fixed fractional method. In this approach, you allocate a fixed percentage of your trading capital to each trade. For instance, risking 2% of your total capital on each trade ensures no single position can drastically impact your portfolio's health. 2. Kelly criterion. This formula helps calculate the optimal position size based on the probability of winning. While powerful, it can be difficult to implement in real-world scenarios due to the need for precise estimates. 3. Volatility-based sizing. Adjusting position size based on an asset's volatility helps maintain consistent risk exposure. Risky, high-volatility assets will have smaller position sizes, while more stable assets can justify larger ones. Stress testing and scenario analysis. Now let's dive into stress testing and scenario analysis, both critical to understanding how your portfolio performs in extreme conditions. 1. Stress testing. This involves subjecting your portfolio to extreme conditions, such as the 2008 financial crisis or sudden geopolitical events. It's a way to preemptively identify weak points in your strategy. 2. Scenario analysis. Unlike stress testing, scenario analysis is more about testing a variety of future scenarios, such as changes in interest rates or macroeconomic shifts. It's about understanding how your strategy performs under different potential futures. By using these techniques, you can prepare for worst-case scenarios and ensure your strategy is robust enough to handle market volatility. Conclusion. In conclusion, risk management is the backbone of successful algorithmic trading. From using risk metrics like VAR and the Sharpe ratio to implementing effective controls like position sizing and diversification, each element plays a crucial role in protecting your portfolio. Remember, ongoing evaluation through stress testing and scenario analysis will help you stay prepared for the unexpected.